Good afternoon. Welcome to today's webinar presented by New Frontier Data in partnership with Cohn Reznick. Today we will be taking a look at the current state of taxes within the legal cannabis industry and provide insight into the dreaded IRS Code 280E. We'll also look at other ways in which you can run your cannabis business to more effectively take advantage of potential tax breaks. My name is Gretchen Gailey, Executive Vice President of Communications and Government Affairs at New Frontier Data, and I will be your moderator. Just a few quick housekeeping items. First, today's event is being recorded and will be made available to you after the webinar. We will send out an email to view the on-demand webinar as soon as it is available. Second, please enter your questions using the GoToWebinar control panel, which is located on your screen. You can start entering any questions you may have now, and we will get to as many questions as we can at the end of our presentation. Now let's take a look at the agenda for today's event. First, we will introduce our speakers and their respective companies, then jump into our main presentation, and finally end with a Q&A. We will take as many questions as time permits. We want to thank Michael Harlow, CPA and partner of Cohn Reznick, for being here with us today and for his insight into ways to optimize your tax performance. Now, before we jump into the meat of our webinar, we would like to ask you a quick poll question. We've been seeing a number of acquisitions around the industry this past year, and we would like to know, do you believe in the next 2 years the number of cannabis business acquisitions will A, increase, B, stay the same, or C, decrease? Please take the time to answer that question now. We'll give you a few moments. All right, thank you for sharing your thoughts. You can keep entering those answers as I go. We will reveal the results after we hear from our speakers. Please remember, as we are going through our presentation, to send in your questions. Now, first to meet our speakers, we have John Kagia, Executive Vice President of Industry Analytics at New Frontier Data, who will tell you a bit more about himself and about New Frontier. John?
Thank you very much for that, Gretchen, and good afternoon, everyone. It's an absolute pleasure to be here, and we're very excited to have this conversation about the evolving tax environment for the legal cannabis industry. My name is John Kagia, and for those of you who don't know us, New Frontier is a data analytics company focused exclusively on the legal cannabis industry. We aggregate data about the industry from a very broad range of sources, including federal, state, and local government agencies, businesses that are operating both within and around the cannabis industry, as well as the medical community and academic environments, to understand critically not just where the industry currently is, but where the industry is going. As somebody who has devoted my career to market research and industry analysis, I've really never studied a business environment that is evolving as quickly as the legal cannabis environment is, not just from the expansion of the industry as new states are coming online, but also in terms of the evolving consumer preferences and demand trends, the very, very dynamic regulatory environment, the tension between federal and state law, and all of the other issues that are shaping the trajectory of this space. Taxes are a critical example of an issue that is significantly impacting this business environment, and that's one of the reasons why we thought it was absolutely critical for us to shed a spotlight on it. So we're looking forward to a very rich and robust discussion about this today.
All right, thank you very much, John. Next, we have Michael Harlow, CPA and partner with Cohn Reznick. Michael.
Hi, I'm Michael Harlow. I'm a partner with Cohn Reznick. Cohn Reznick, unlike a lot of the other accounting firms operating within the cannabis industry, is not a cannabis-specific firm. Cohn Reznick is a national accounting firm serving clients across the attestation, audit, tax, and consulting arenas. Cannabis just happens to be one of the many industries in which we operate. We're excited to be operating within the cannabis industry and excited to bring all of our industry expertise in tax planning and strategizing knowledge from all other industries into this industry. So thank you so much for having me. As we go on, if there's any confusion when we're speaking about whether or not it's John or myself, just keep in mind John is the one with the cool accent and I'm the other guy.
All right, well, good tip for our listeners. All right, well now as we head into our discussion, John will be leading the way. John.
Thank you very much, Gretchen. In thinking about why this issue of understanding your tax exposure and optimizing your tax profile in the legal cannabis industry, we thought it would be important to contextualize why this issue is so important and what sort of industry dynamics are impacting the imperative for cannabis businesses to dial in their accounting and tax profile. One of the major trends that is shaping this is the evolving demand for consumer products. In most markets, when cannabis first legalizes, you see that flower dominates consumer products, generally accounting for over 90% of total sales. But as you see in this chart here from Oregon, just between November of 2016 and December of 2017, the share of flower fell from 71% to 59%. And much of that was because flower sales were being cannibalized, or the share of market of flowers being cannibalized predominantly by the growth in demand for concentrates and extracts. Why is this important? Well, we know that there's an enormous amount of research and development that's going into novel delivery mechanisms, new ways to ingest and consume cannabis. And that investment in the research and development of new cannabis products is part of the type of investment that should be factored into your tax deductions and business incentives. And based on our assessment of this industry, we realize that that's one of the aspects of the tax exposure that cannabis businesses are not taking advantage of, and that's the R&D tax credits that cannabis businesses can capitalize on. Similarly, we've seen an enormous amount of innovation happening in the cultivation space. In this slide that you have in front of you, the insert image, the smaller yellowish image, is a photograph of a fairly standard, let's call them first generation cultivation environment, a warehouse where it's indoor using traditional lights, very energy intensive, and generally very resource intensive. But this is the way cannabis has been grown for much of the past 50 years. Now, in the larger image, you have what we're calling an example of a next-gen cultivation facility. This is a facility that's been built by a company called iGrow, and it's a showcase of a new greenhouse that they've built in Northern California that has a few really extraordinary innovations. First, there are photo sensors at the canopy level which determine the amount of light hitting the canopy, and if there's a change in the amount of light hitting the canopy, two things happen. So, for example, if a cloud were to drift in front of the sun, reducing the amount of light getting to the canopy, a couple of things would happen. First, it would automatically activate the supplementary lights that iGrow has installed in the greenhouse. But second, and critically, it actually lowers and raises the height of the light in real time to ensure that the same amount of light is hitting the canopy throughout the day. And all of these adjustments are being done in real time, and all of this is being controlled from an iPad. This is an extraordinary amount of technology and a fairly high capital investment that has gone into building this facility. And as growers are making these investments as they transition from, let's call them Gen 1 facilities to Gen 2 or next gen cultivation environments, there are huge opportunities to reap tax credits, tax deductions from those investments that we know that cannabis growers are not investing in and represent a significant missed opportunity. A third reason why it's absolutely critical to optimize your tax profile, and that's because the market is becoming highly competitive. Using Colorado as an example of the very significant price declines we're seeing on both the wholesale and retail side. In Colorado, when the adult use market activated in January 2014, the average market rate for a single pound of wholesale cannabis was just under $1,900. And it remained at that level for the first 2.5 years that the market was in process, bouncing between $1,800 and $2,000 a pound. And then in Q3 2017, the average market rate fell to $1,300 a pound, and that's a decline in pricing that we're seeing being replicated in all of the large established markets. We're also seeing a similar decline on the retail side. We were just in Denver last week and talking to dispensary owners who've seen the average price for an eighth of an ounce on the retail side fall from $60 to, in some cases, as low as $25. These downward price pressures are placing significant pressure on business margins, and it means that cannabis businesses cannot afford to leave any money on the table. Disaster recovery and continuity of operations. For anyone who's been watching the news lately, we've seen acutely the impact that natural disasters have had on the cannabis industry. Whether it's the fires that have raged in Washington, Oregon, and California, whether it was the hurricanes that pummeled Puerto Rico's cannabis industry, as well as the burgeoning industry in Florida, or whether it's apocalyptic snowstorms that have posed supply chain and logistical challenges to producers in the north of the country. Cannabis businesses are exposed to significant risk to natural disasters. And the imperative of having accurate and precise accounting of your assets isn't just for recovery purposes. You really don't want to be in a position where you're trying to figure out what you might have lost in a fire. And critically, if you have assets that are not being used on the property, use an example of a company that has a cultivation facility that may have updated its facilities, lighting structures, lighting systems, but kept the old systems on the property. You want to make sure that you're not paying taxes on assets that you're not using on the property, and those are being appropriately accounted for and disposed of. So, you know, God forbid your cannabis business does get impacted by one of these disasters. But in the case that it is, one can save the business and yourselves a great deal of problems and significant time if your books are clean, your assets are appropriately accounted for, and that can help expedite getting your business back on track, back online, and back in business. And a final reason why it is so important to really think about getting your tax affairs in order. The cannabis industry is undergoing an enormous amount of consolidation. There's a number of reasons for this, and many of them are related to the points we've just discussed. As prices decline, as the market grows more competitive, it's becoming increasingly challenging for lower performing businesses to remain viable in this environment, which is partly what's fueling this M&A activity. We have a great example of the new entrants who are coming into the space and eyeing cannabis assets. Constellation Brands, one of the world's largest alcohol companies, recently made a $250 million investment in Canopy Growth, Canada's largest Canadian cannabis producer. these types of, while that is a Canadian example of the M&A activity that we're seeing, it's illustrative of the trend that is accelerating on both sides of the border. If you are considering being an acquisition target, if you are in the process of evaluating potential acquisition targets, ensuring that those acquisition targets, those businesses have their books in order is absolutely critical. Because no business wants to pick up or to merge with or acquire a company whose books are, let's call it, messy. And indeed, we have a partner who recently had to walk away from a company that they'd been very, very interested in acquiring. It was going to be a fairly substantial cannabis acquisition in the US. It was going to be about a $20 million deal. But once they started looking at the books, they realized that because the business had not appropriately done their tax accounting, it had more than $20 million in tax liabilities that were not paid, and that was just too much risk and exposure for them to move forward with the deal, and ultimately they walked away. Having your tax affairs in order will help minimize the risk that one faces of an acquisition deal going sour, and it makes one a more attractive acquisition target in an environment that's getting more competitive and where the best deals are the ones that investors and acquirers are most interested in. So that's just some context of some of the trends and issues that are fueling this interest in, or fueling the imperative to have your tax affairs in order. And so I'll turn it over to Michael to walk us through some of the key tax dynamics that cannabis businesses need to be thinking about and focused on.
Thank you, John. So I want to set the stage a little bit. Most of what we're going to be talking about this afternoon is going to be focused on federal income tax. But that's only one part of your overall tax strategy or tax compliance issues that you have to deal with. To John's earlier points, simple items such as fixed asset accounting are going to have a significant impact on your property tax assessments. The example of LED lighting systems where we've seen clients buy lighting systems only to find out 6 months later they don't work the way they expected and then replace them, or have clients put HVAC systems in Massachusetts that were based on California models that didn't work. They have duplicative systems on the books. If you're not correctly accounting for those and writing off those abandoned, those scrapped assets, those are still sitting on your depreciation schedule and most likely still on your property tax schedule. So just something to keep up, to point out that even though this afternoon we're talking about federal income tax issues, there's much more to be focused on that we can talk about in subsequent thought leadership pieces or webinars. Now, I want to take a minute to talk about 280E, but I really don't want to spend too much more time on this. This is a very hot topic within the industry. I think it's been discussed quite a lot. If you've been in the industry for any period of time and you haven't heard about 280E, you've probably been missing the boat. So 280E is the IRS code section that deals with illegal activities and specifically disallows any cost other than cost of goods sold in calculating taxable income. So you cannot deduct anything that would otherwise be ordinary or necessary business expenses. You're only limited to your cost of goods sold. Now, we've seen a lot of cases where clients have shortcut this process. They've simply bifurcated their P&L between their direct costs, being their cost of goods, what they believe to be their cost of goods sold, and their indirect costs or administrative costs. Technically, that's not sufficient. In reality, what you have to do is take those direct costs, capitalize them into your inventory, cost out your inventory so that your cost of goods sold, or those costs are allocated to every unit of production, and then you don't get a deduction for those costs until you sell the underlying inventory. We see that step missed a lot. So your total cost pool may be accurate, but your taxable net income, if you're not costing it out into your cost of goods sold, is not going to work. For example, all of those costs of goods sold in the first year of operations, before you've sold anything, before you've sold that first unit, nothing is deductible because everything has to be capitalized in the cost of goods sold, and it's only deductible after it's then costed out. So this means that your not only is your identification of direct costs versus indirect costs is important, it's the time that you put into setting up your costing system and your inventory module is extremely important. And we've seen lots of clients who do not have sufficient, in our view, inventory costing systems or an accurate year-end inventory system. Now, because of the seed-to-sale software, they probably have a very good idea of exactly what they have on hand production-wise, but they don't have a very good idea of what they have on hand when it comes to cost. The general number that is thrown around the industry for an effective tax rate for a 280E impacted business is about 70% effective tax rate. We tend to agree. We think that's a pretty good rule of thumb. Now, there is a big difference in the impact on 280E between different types of plant touching businesses. In production and cultivation and processing facilities, 280E is probably not as big a problem as in retail dispensaries, because 90% of your cost in a strict production facility is going to be cost of goods sold production related. Whereas in a retail environment, most of your costs are going to be non-deductible. So commonly disallowed expenses are going to be your normal wages and salaries, utility costs not related to production, health insurance, marketing, advertising, repairs and maintenance, business meals, contractor payments that are production related, and rent that's not for facilities that's not directly production related. Now we also understand that there are a lot of people in the industry who've taken the position that 280E does not apply. I can tell you that when Cohn Reznick made the decision to enter the market, we did a lot of research on this position. We can't find anything supported by any authoritative guidance or case law to support that position. We believe that plant touching businesses are impacted by 280E. And we believe that tax preparers that are taking a contrary position, while they may be well-intentioned, are certainly reducing the future business value of those clients' activities because of the unfunded and unidentified future tax liabilities. Now, keep in mind, 280E is a federal concept. So for state purposes, most regulated states allow an add back to the state tax return for those deductions that are disallowed on the federal return. So Colorado, for example, actually asks you to attach a copy of the federal return that they call an as-if federal return. It's a federal return recalculated without the 280E limitations, and that's your starting point for your Colorado taxable income. So you don't necessarily have the same state limitations that you have federal limitations as a general rule, but you have to look at a state-by-state basis to make sure that's the case. Okay, that focuses on your plant touching 280 impacted businesses. Now, as a firm, as I stated, we believe that 280 limitations do apply. So then the question becomes, okay, what can we do for clients to minimize that 280 impact? And there's not a heck of a lot you can really do other than being really sophisticated with your cost accounting system to limit your 280 impact. Most people that we talk to within the industry are invested both in plant touching businesses and various ancillary businesses. Therefore, we think that the real tax savings and where clients should really focus on is on their ancillary businesses. Because at the end of the day, and particularly in passive environments, LLC, partnership, or S corporation, the final tax is paid at the individual level. So getting a deduction on the ancillary business that flows to an individual taxpayer gets us the same benefit as getting a deduction on a 280E impacted business, because it all ends up on the individual tax return at the end of the day. Now, in our experience, as we go to trade shows and conferences and talk to clients within the industry, we find that even within the ancillary businesses, most people are not taking advantage of, to us, what are very common deductions or common tax incentives that we see in every other industry in which we operate. And these aren't anything that we would consider to be particularly aggressive tax strategies. So we'll talk a little about cost segregation studies, bonus depreciation, R&D tax credits, 199 domestic production deductions, and work opportunity tax credits. And if you go back and look at the cannabis articles that we've written with New Frontier over the past several months, you'll see these on the website in a little more detail than I'll go into here today. So a cost segregation study is essentially a study that componentizes the various portions or components of a building. So if you have a $10 million cultivation facility, the general default would be to take that cultivation facility and capitalize it as a building over 27.5 or 39 years. In a cost segregation study, you're looking at all the 5, 7, and 15-year assets to accelerate your depreciation. So a cost segregation study is not a tax avoidance strategy, it's a tax deferral strategy. We're trying to take deductions that we would get over the entire life of the building, breaking them down into shorter life assets so that we get those same deductions faster. Now, in a 280E impacted tax return, the cost segregation study is going to have limited benefit. You can still accelerate your 5, 7, and 15-year assets, but you're not going to be able to take bonus depreciation because in 280E impacted businesses, your depreciation deductions are capitalizing the cost of goods sold, and your depreciation deductions are limited to the depreciation you would take on your financial statements. Generally, that's assumed to be GAAP or generally as accepted accounting principles. So there is a benefit to cost segregation studies, but there's a much greater benefit in your ancillary businesses. This is also brings to light why it's so important that we get in front of these things in the very beginning of business structuring, is if all of your real estate and assets are in the same business entity as your plant-touching businesses, the benefits of cost segregation studies and bonus depreciation are going to be limited. Whereas if your operating business is strictly plant-touching cultivation operations and real estate and fixed assets are on another non-280E business, you could still have significant benefits. Now, as part of tax reform, bonus depreciation was 50%, meaning you could take 50% of the cost of new acquisitions of 5, 7, or 15-year property in the year of acquisition or the year placed in service. It's now 100%. So if you had looked at cost segregation studies in prior years and there was some moderate benefit, there's definitely going to be much more of a benefit in the current year. Okay, so let's talk about some of the things that did change related to tax reform. We were all hoping for some kind of 280E fix. That didn't happen. The likelihood of getting some 280E fix or correction now separate from larger tax overhaul is, probably slim. I just don't see a standalone separate 280E bill advancing all the way through the House and Senate right now. So we're going to table that for the time being. There are some real benefits to the cannabis industry buried in the tax reform bill. Primarily, we'll talk about three things: the reduction in the corporate rate, the new 20% pass-through, and the 100% bonus depreciation. The corporate rate has gone down from 35% to 21%. So if you were looking at in the C Corp environment at an effective rate of 70%, you're probably now closer to 50%. Still not great. I mean, it's not the envy of the rest of the business world, but it's a lot better than 70%. So without changing anything else, you're going to see a reduction in your C Corp rate. So that's very positive. There's also a new, and this is a new concept. This is one of the few things in the tax bill that's truly a new concept. We have this new 20% deduction that's calculated outside of the pass-through entity. So if you have an LLC, partnership, sole proprietorship, or S corporation, income is flowing directly from the business to the individual owners and reported on the individual owners' tax returns. There's a 20% deduction based on your qualified business income. Now, there are certain industries that are specifically listed in the regulations or in the law that are excluded or limited in being able to take advantage of this, primarily professional service organizations. It's worth noting that cannabis is not one of them. So, it's very early on. We still haven't seen any guidance or any regulation issued by the IRS on how exactly this is going to work. But as of right now, a literal reading of the code would suggest that the 20% deduction would apply to 280E impacted businesses. Now, as I said, this is very early in the process. We haven't seen any regulation or guidance from the IRS or the Treasury, and this could all change. And there's a lot of debate about this particular topic. So nothing is settled. I'm sure over the course of the next 18 months, there's going to be a lot of back and forth on this particular issue. But right now, at the onset, it appears that this could be a significant benefit to the industry for those entities or businesses set up as pass-through entities. All right, we talked a little bit already about the new capital asset incentives. Bonus depreciation went up to 100% for 5, 7, 15-year property. That's going to be a very big incentive for any capital-intensive real estate or equipment ancillary businesses. Unfortunately, we did lose with the repeal of the domestic production activities deduction in Section 199. That no longer exists. But it's worth noting that some benefits, specifically the research and development tax credit, did survive. There was a lot of debate about whether the R&D credit would survive. It did. It's now been renewed for 20 plus years through various tax changes. So we feel pretty comfortable that the R&D tax credit is here to stay. All right, so let's back up a little bit and talk about how exactly cost segregation studies work, because we talked about this a little bit earlier. So if you have a $10 million capital investment in a new cultivation facility, the default would be to lump all that into the building costs and depreciate over the life of the building. But we know that within that total building cost, there's a lot of different components. You have the equipment, the lighting, the electrical systems that support the lighting, HVAC, specialty low voltage wiring for data inputs, a lot of things that are not critical to the structure of the building that can be separately broken out from the building and depreciated over either 5, 7, or 15 years for land improvements. So again, this isn't a tax avoidance strategy, it's a tax deferral strategy. It's a simple time value of money calculation. How much more of this investment can we deduct now as opposed to 20 years from now, and what's the value of that? Our general rule of thumb is that in order to do a full-blown cost segregation study, you need approximately $1 million in building basis to justify the time and the cost of the study. That number may actually be coming down a little bit now that we think about it, because with the new 100% bonus depreciation, we're getting even more deduction up front. You're getting more bang for your buck for the same cost of this study. So what we would do is we sit down, this is an actual engineering study. You have an engineer come out, look at the property, or in new construction, look at the building construction drawings and the contract schedules, break out 5, 7, and 15-year property and use that as your support for the depreciation that you're going to put on the tax return. As I said earlier, this is primarily for ancillary businesses, although this would still be benefit to 280E impacted businesses. If you can pull out 5, 7, and 15-year assets, you're just not going to get bonus, but you'll still get the deduction much faster than you would if it was buried in the building basis. Okay, so in the best case scenario, you do this at the time when the building is placed in service. That's the easiest thing to do. But you can also do this on acquired property or a property that you built in prior years. You can do a cost segregation study now and use a Form 3115, a change in accounting method, and attach that to the currently filed tax return. And essentially, you get a catch-up deduction for all that depreciation you missed in prior years. So if you're in the 4th year of a 5-year, or if you're in the 5th year of a 5-year asset, when you file that 3115, you would pick up all the depreciation of those prior years that weren't taken and put that on a current year return. So that's very nice because it means that you can get the benefit of all those deductions that you may not have taken advantage of without having to amend 4 years worth of tax returns. All right, now on the valuation side, we talked a little bit earlier about the importance of keeping good books and records. And we see this a lot. We see people trying to minimize their current tax exposure by kind of skirting the rules on 280E or being sloppy with their cost accounting methods. And it may save a couple dollars in federal income tax today, but at the cost of your business valuation long term. It's very difficult to accurately value businesses within this industry for a number of reasons. There's a lack of market data, which New Frontier, of course, is addressing. There is different regulatory regimes across the country. There's a limited number of investors and limitations on financing. But in the research or the review that Cohn Reznick's valuation team has done, we also believe that there are overly conservative valuation discounts being placed on businesses because of risk. We're seeing risk valuation discounts placed on cultivation facilities that are double what we would expect to see in other industries. And there is some precedent for other industries. I mean, if you look at a cultivation facility that is very energy intensive, technology intensive, capital intensive, it starts to look very much like a data center. And there are accepted valuation methodologies for data centers and lots of data center data. But we're seeing risk discounts of twice what we'd expect to see in any other asset class. And people seemingly have just taken that for granted, that that's acceptable or normal, and the premise is that there's some risk of federal forfeiture or the state's going to come and take your facility, and therefore you need this giant risk discount. But we're not actually seeing that happen. There's always that risk out there, but historically speaking, we're not seeing feds coming in and taking over cultivation facilities in regulated markets. So we tend to believe that their valuations are understated within the asset class. All right, so let's talk about some key takeaways, and then we can open up to questions. John, feel free to jump in whenever you like. We do believe that people operating within the industry are not taking advantage of all of the normal business deductions available to them. We're not seeing ancillary businesses that are investing heavily in R&D take advantage of R&D tax credits. We're not seeing businesses that are employing people take advantage of work opportunity tax credits. The work opportunity tax credit is one that I think politically is ripe for utilization. I mean, if you think about it, the work opportunity tax credit is a tax credit based on employing people primarily in disadvantaged populations and veterans. So I would love to see someone take advantage of the work opportunity tax credit, put that on a return, employ veterans, disadvantaged populations, prove that they're growing the job base, only to have the Treasurer of the IRS come back and challenge that. I mean, that seems like a very easy case to fight, at least in a public relations political environment. You know, the R&D one, as I referenced earlier, is another one. I mean, if you go to a conference or a trade show within the industry, you can't help but be amazed at what kind of new technology is coming online, being the extraction equipment, lighting equipment. All of these companies are investing heavily in research and development. And for those companies that are doing it using U.S.-based employees that they pay W-2 wages to, there should be an R&D tax credit there. And we see clients taking advantage of the R&D tax credit in any number of other industries that you may not suspect. It is not despite popular misconception, is not a credit limited to pharmaceutical and biotechnology companies. But we don't see people doing it. So we think there's significant untapped opportunities. As I stated earlier, we truly believe that 280E applies to all businesses until there's some legislative change. That is going to be our position. We understand there are people out there taking contrary positions. That's perfectly fine. I would just make sure or ask that they consider what kind of negative impact they may be having on their future business valuations if that's the position they're taking now to minimize federal taxes. Particularly in the processing and cultivation side, where most of your costs, if you accurately account for your direct costs and capitalize the inventory, 90% of your cost is probably going to qualify anyway in the production, cultivation, and processing side. So why are you skirting 280E and creating a potential unfunded federal tax liability that's going to hurt you later on down the line when it's probably not costing you that much in today's dollars?
And if I could just add to that, the exposure there is not just on your federal liability, but it is also on your acquisition, on your attractiveness as an acquisition target. As I said earlier, we know of at least a couple of deals that have fallen through because plant-touching businesses believed that they were not exposed to 280E, and the companies that looked at acquiring them believed that they weren't, decided that the books were such a mess that they weren't willing to move forward with it. So if you are taking a contrary view, as Michael said, just be acutely aware of what the trade-offs could be to the long-term attractiveness of your business.
Exactly. Okay. We are at a unique point in time right now, because normally, I would say 90% of what we do as tax accountants to try to improve the tax position of our clients is related to tax deferral, not tax avoidance. There's relatively few ways you can truly avoid federal income tax. So most of the strategy is related to deferral. You're accelerating deductions, you're trying to defer revenue recognition. The change from 2017 to 2018 is one of the few cases where you actually have the opportunity to avoid taxes, because accelerating deductions into 2018 is going to generate you more benefit than taking the same deduction in 17 as opposed to 18 because of the reduction in the rates. So one of the things that you should really take a hard look at before you file your 2017 tax returns is looking at any of your capitalized costs, your buildings, your equipment, particularly things in a non-280E impacted business, and pulling out all of those shorter-lived assets and deducting as much of that as you possibly can in 2017. One, you're going to get a better deduction in 2017 because the rates are higher. And two, if there's actually so much cost there that you generate a net operating loss, keep in mind going forward, net operating losses are going to be limited to 80% of taxable income. So in 2019, if you have $100,000 of taxable income and you have $100,000 net operating loss carry forward to 2019, you're only going to be able to deduct $80,000, leaving you with $20,000 of taxable income in 2019. You're still going to pay tax on. You cannot use an NOL generated in 2018 to completely eliminate taxable income in future years. However, if you were to do a cost segregation study in 2017, catch up all your depreciation, generated net operating loss, under the current law, you carry back 2 years, and if you still have net operating loss able to carry forward, that loss is not going to be impacted by the 80% limitation. So we believe that every client should be taking a hard look at their fixed assets as they prepare their 2017 tax return, because you won't get the same benefit in 2018. 2018, you'll get different benefits. You'll get 100% deduction, but you're not going to get it against the higher current tax rates.
So maybe the final point we would make as we close this out is one of the things that really jumped out to us as we began working with Cohn Reznick on this, and Michael and his team, was just how much more there was to this tax issue than we felt cannabis businesses were paying attention to. There's been so much focus just on this 280E issue that it really underscored that there's a lot more at stake, and a lot more of that can be done to improve the cannabis business tax profile. That unfortunately, not a lot of industry-focused tax and accounting professionals have been capitalizing on. And so as we go into tax season for 2017, and as you start planning for years ahead, we can't underscore enough the importance of choosing tax and accounting professionals carefully, and making sure you're getting sound advice. Because the way you set up and structure your business today could have profound implications on how you operate, how you sell, and how you transact in years to come. And you want to make sure that you put yourself in a position that enables you to operate most efficiently, optimize your costs most effectively, and make yourself as attractive as possible as an acquirer or as an acquiree in this highly evolving environment.
All right, thank you, John and Michael. We'll now head into our Q&A portion of the webinar, and we'll take as many questions as time permits. And please remember to send in your questions at any time using the GoToWebinar control panel. But before we jump in, we're going to take a look at our poll question and see our results. We asked earlier today if you see acquisitions over the next 2 years increasing, staying the same, or decreasing. 95% of you are going with increasing. By the smile on John Kagia's face, I would guess he agrees with you.
Very much so. And if you saw the news just this morning, there's been a couple of deals announced today alone. So this is certainly a trend that we expect to continue to go. All
right. Our first question, and John, you may get to take a breather for quite a while because a lot of these seem geared towards Michael. What should I do if my tax preparer is one that thinks 280E does not apply? Is that a question I should use to vet potential preparers?
That's a good question. I would respectfully disagree with your preparer. There's a couple things to consider from your standpoint. Your tax preparer, they're subject to penalties for IRS for misstating or filing incorrect tax returns. But their penalty is not going to be as significant as the penalty that you would be subject to. So the risk, we look at risk all the time when we're taking positions on tax returns and determining what we feel comfortable signing our name to, and because there's a reputation associated with our name that we hold very dear. But you also have to understand the risk to you. If you rely on that tax preparer and you file a return without 280E exclusions, the IRS is not going to allow you to use the defense of, oh, my tax preparer told me it was all right, to waive the penalties and interest on that liability if and when you're audited. So it's your tax return, it's your personal liability, it's your money at the end of the day. I would ask, maybe you could push back and ask the tax preparer what kind of IRS audit defense they're willing to offer in the case they take that position.
Okay. John, you talked earlier about prices falling. If they continue to fall, what impact do you see them having?
We think there'll be a number of effects. One is that it's only going to help accelerate the rate of acquisition and mergers in the space. We do think that, and we're already starting to see this in markets like Oregon and Washington, where some businesses are just finding it, they're not structured in a way that can survive these price declines, and are therefore either selling their licenses or being acquired because of it. Second is, we think in the long term it starts to impact business valuations. So if we think about the fact that cannabis businesses, in publicly traded cannabis businesses, and using the Canadian publicly traded companies as an example, they are operating at extremely high valuations, multiple times higher than you would typically see in a public market setting. And some of that is just fueled by speculation. But as we start to see this downward price pressure, this increased competition, we do think that's going to help bring down business valuations and restore valuations to something that more closely resembles the real world, rather than this supercharged cannabis industry environment in which we're in right now, where companies are really trading at extraordinarily high valuations in the public markets especially.
Okay, thank you, John. Michael, can expenses associated with collecting product efficacy data from patients be categorized as R&D?
That's a good question. It depends on what the actual expense is for. The R&D credit is largely a wage expense credit, meaning that you're looking at if you back up and think about the R&D tax credit and the production activity, domestic production activity deduction, which was repealed this year, most of these tax incentives are meant to incentivize something in the U.S. Oftentimes it's employment. So the R&D credit has a wage component to it. So you get more benefit or more credit if you're employing people in the U.S. as opposed to using contractors to do the same work. So when you're talking about collecting data, my question would be like, what is that spend on? Is it spend on research firms? Is it spend on you employing W-2 employees to do something? Generally speaking, to make an R&D credit study, is what you want to do. You engage a firm such as Cohn Reznick to do the study. The study is what calculates the credit and is then put on the tax return. We like to see a W-2 spend on R&D activities in excess of $1 million to justify a full-blown study as a general rule of thumb.
Okay, also Michael, you said earlier that 280 general tax rate is around 70% for all dispensaries. Did you mean 70% of gross profit?
Yes, gross profit. So your total gross revenue minus direct cost of goods sold.
Okay. Another quick question for you, Michael. Are there benefits for cost segregation studies for leased real estate or just purchased real estate?
Oh, man, that's getting complicated. It depends on the structure of the lease as to whether or not it's a lease that actually transfers tax ownership or if it's a lease that stays at the leaseor. So you want to look to see if there's some kind of bargain purchase option or something else that actually makes the asset of the operator. But without doing a more detailed analysis of the lease, I couldn't really say. I think I could say that in most operating leases where the asset resides with the leaseor, the benefit is going to be to the leaseor, not to the operator.
Okay, we'll give you a break for a few seconds. John, do you see the Cole memo reversal impact on the IRS behaviors in this arena?
Well, we certainly know that broadly speaking, the federal government or the Trump administration has been much less receptive to the idea of legal cannabis than the Obama administration. And that's manifested itself not just in the position that the Department of Justice has been playing in the way it views state-level legalization, but also in everything from the way the IRS is, the Immigration Nationalization Service is viewing people who are employed by the cannabis industry, immigrants who are employed by the legal cannabis industry. However, the Cole memo rescission was really just a restoration of enforcement latitude to the U.S. state attorneys within the federal government, it did not necessarily provide any direction or directive to any of the other federal agencies on how to view this industry. So, we think it fits broadly within the Trump administration's view that perhaps there should be some greater enforcement of federal prohibition in legal cannabis, but it did not provide any specific guidance to the IRS on how to deal with it. So it may lead to some auditors looking more closely at the industry, at cannabis business filings, but there was no specific directive there on what the IRS should be doing.
Okay, our next question will go to Michael. If I acquire the assets and liabilities of pass-through entity, such as a partnership, does this historic 280E liability remain with the former owners, or does it pass through to the new owners? And does it make a difference if I acquire the assets or liabilities in a new C Corp?
Okay, good question. So, and this is fundamental to a lot of the issues that you're going to see with business combinations or acquisitions over the coming years. The primary reason why people want to do asset acquisition, well, two reasons, but one of the big reasons people want to do asset acquisitions is because they are buying just the assets and theoretically avoiding the historical liabilities or unknown liabilities that may be associated with it. So that's a very common strategy. Another thing that we see happening a fair amount within the industry is in the pass-through structure, new investors may come on over time, and you need to understand how IRS audits work in a partnership, LLC, or S Corp environment. In the past, if the IRS had undertaken an audit of a partnership and had found a change, they would have made that change at the partnership level and enforced that adjustment down to all the investors. So the actual tax liability would have been at the individual level. That's changed recently. Now the IRS has the ability to calculate the change and assess an effective tax rate at the partnership level. Now that's important because if you are a new investor to the partnership and the tax and the tax change is calculated at the partnership level related to a period before you became an investor, it's still going to be assessed at the partnership level. It's still going to be taken out of the partnership assets. So new investors are going to be on the hook, or could be on the hook, for sins of the past. So that's why new investors coming into an existing partnership structure are really going to want to do their due diligence about federal tax issues that may have happened in the past.
Okay, well, it looks like we're hitting our 60-minute mark here, but we have a number of questions coming in, so we're going to keep going for a few more. Michael, can you tell us what impacts affects distributor entities in California? Does 280E affect distribution companies? Why don't we just start there? Would a distributor be considered under 280E?
Well, when you say the distributor, like, let's define what exactly that is, because are you talking about somebody that's, go on, John, why don't you take a crack at it?
Yeah. So when we talk about distributors in California, and here specifically we mean distributors who got a license from the states to be a cannabis distribution company. Mm-hmm. My view is that if you are getting a special license from the states to be a cannabis, or to operate as a legal cannabis entity, then I would think that 280E would apply to you. Because
you're picking up product and moving it from one place to the other.
Absolutely. And particularly because the distributors are moving very substantial amounts of weight. There have already been a couple of cases where distributors in California had the product intercepted because they started, even though they were permitted by the state, there's some tension between federal and state law. I would think that distributors in California are exposed, and distributors in particular should be very, very careful on how they address this issue because of the volumes of products involved that they will be that they're moving around their respective markets. So again, consult with your tax professional But our view is that distributors, just like producers, purchasers, and retailers, are exposed to 280E.
Okay.
Yeah. I mean, I think that's going to be tough, particularly since they're going to have a minimal, if any, cost of goods sold. Yeah.
So that brings me to our next question, because we are getting a number of questions about various businesses and whether or not 280E would affect them. And so I'll let John and Michael weigh in on this, but what do you consider an ancillary business?
So generally when I'm segregating the industry into two basic buckets. Your plant touching 280 impacted businesses and your ancillary businesses being everything else. So when I say ancillary, I mean anything from the LED lighting companies, the nutrient companies, real estate investment companies, anything that's not directly plant touching.
I would completely agree with that. So, and one way to think about it is, if your state is issuing you a specific cannabis business license to operate, then you're generally going to get a plant touching plant, maybe with the exception of testing labs. And I'm actually curious, Michael, would you put testing labs, cannabis testing labs, as a 280E exposed entity or not?
I'm not sure I'm willing to go on the record.
Fair enough. Another good one for your tax professional, or at least let's take that offline.
Without taking that specifically to my national tax guide.
Okay.
Good question. There was I saw a question about R&D tax credits in a 280E environment. Yeah, so let me clarify. 280E does limit R&D tax credits. However, it's our view that there's a lot of research and development being done in the ancillary businesses. I mean, the LED lighting companies, the software companies, the nutrient companies, so the extraction companies that are building the extractors.
Vaporizer manufacturers.
Yes. So, yes, I didn't mean to overstep that. We do believe there's limitations on the 280E impacted business. I just happen to believe that there is a lot of investment in R&D going on throughout this industry, and a lot of it happening in the ancillary side of the business.
A quick question for you, John. Do you see capital moving from the West Coast more to the East Coast now?
Good question. So we've seen two dynamics happen simultaneously. One is, yes, there has been capital that has moved from the West Coast to the East Coast, as businesses very aggressively pursued licenses and infrastructure investments in the newly licensed or the newly legal markets. However, now that the application process for most of the East Coast markets is now closed, much of the capital being raised is now just to help structure the businesses. It's less focused on license acquisition. We've also seen a huge amount of capital flow north into the Canadian market, partly because of Canada just being an attractive market because it's nationally regulated as opposed to the US state-by-state model, which has put some limits on how large the businesses can grow. But also because Canada is expected to fully legalize adult use this July. And again, as a nationally legal market, which has the full faith and credit of the Canadian government, the Canadian cannabis industry is going to be able to, for example, set up import-export deals, which they're already in the process of doing, enabling Canadian producers to get their product onto store shelves in other countries around the world. That presents a much, much more substantial growth opportunity for Canadian companies than we see in the US. And it's one of the reasons why we're seeing these really supercharged valuations in Canadian companies. Canopy Growth, last I saw, was trading at about a $5 billion valuation. There's no one in the US that's trading anywhere close to those sorts of numbers. And that's predominantly hinging on the expectation that the Canadian will legalize this July, and that this global expansion strategy that we're seeing amongst many Canadian companies will continue.
Okay, John, it looks like we have, or Michael, do you want to add to that? Nope. No. Okay. I was going to say we have time for one more question, and this is my own question for you, Michael. Are licenses or fees to the state tax deductible?
Well, let me back up and say that nothing there's gray area in everything within this industry. So as we alluded to earlier with the question about the tax preparer saying 280E doesn't apply, it's up to individual taxpayers and preparers to get comfort with the positions they're putting on tax returns. And in a lot of cases, there is no definitive answer. I think in this case, we can kind of theorize that there are different licenses for different parts of the business across the country. You have, I mean, Maryland, for example, where my office is, you have production, cultivation, processing, and separate retail licenses. It would make sense to me that license fees specifically related to production or cultivation or processing are integral to your production activities and part of your cost of goods sold. Whereas license fees related to maintaining a retail license for a dispensary, by definition, are retail related, which would be excluded from cost of goods sold. So I can't give you a 100% definitive answer, but I think there's, we can come up with some pretty safe bets.
Okay, John, you have any closing thoughts on today's webinar?
Thank you, Gretchen. Just one. We've covered a lot of ground here, and I hope this has helped underscore just the scale and complexity of this tax issue and the imperative of working with professionals. But I would like to add a secondary point, and that's this. We know that unlike under the Obama administration, the Trump administration is taking a more dour and critical view of the cannabis industry. And it's going to be, it's really important that cannabis businesses make sure that they are operating above board, meeting both the spirit and the letter of the law, because things that you may have been able to get away with under an administration that may not have been paying as close attention to the industry might lead to greater exposure under the current administration. So, you know, this isn't just good business practice. You know, by doing this right, by getting this right, you may also be reducing your legal jeopardy in an environment where this industry is going to be under greater scrutiny than it may have been in previous years, and you want to make sure that you minimize your exposure in that regard.
I would agree completely. And most clients that we see reaching out to us, or most potential clients, are calling us and expressing a desire to do everything they possibly do to be above board, to follow the letter of the law, to have audited financial statements, to have strong costing modules, to understand exactly what their inventory is. They want to position themselves to be above reproach from both a regulatory standpoint and a future due diligence standpoint. So we see a lot of motivation within the industry to do things right, not just for the sake of you know, doing it right, but because they actually believe there's value there in protecting themselves and growing their brand and their business.
All right, thank you so much, Michael and John. We are out of time, and we'd like to thank all of you for your questions to our panelists. And thank you for joining us today. As an added bonus for participating in today's webinar, we are providing a 15% off promo code for all of New Frontier Data's reports and services. Just use the code CANATAX15 on our website, www.newfrontierdata.com. And if you would like more information about New Frontier Data or about Cohn Reznick, please do not hesitate to reach out. Now, as mentioned before, a recording of this webinar will be sent out to all participants a little later this week. Thank you again for joining us. Have a great day.